Good afternoon, this is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, February 10th, 2016, featuring Update Analytics. We'll incorporate data from the Update Energy Feed, the Energy Information Administration, Baker Hughes, and CME Group NYMEX. Highlights from this week's report: we experienced a slight production decrease while still continuing the century-low total rig count. Commercial crude oil had a 754,000 barrel drawdown. Cushing, Oklahoma, total petroleum and gasoline all set new records, and we'll also explore volatility in the short-term positive dollar correlation this week. Let's go to the charts. Beginning with U.S. continental production for the lower 48 United States, this week we have a slight reduction down to 8.67 million barrels per day, still working below the flattening 52-week moving average. Over to U.S. field production, so this is the lower 48 plus Alaska, down to 9.19 million barrels per day and below the 52-week moving average. I'm going to scroll back out on this chart. We'll come back to it a little bit later, but wanted to just note that back here in February, March of 2009, so almost 7 years ago, we were down at about 5.3 million barrels per day of production, and today we're almost twice that. Commercial crude oil storage, the bottom pane is where we show the weekly delta. You see the 754,000 barrel drawdown this week, down to 502 million barrels, just a tick off of the all-time record we set last week, and still well above the 491 million barrel record from 2015. Similar to production, I wanted to make a note back here, go back to 2009, 351 million barrels in storage back in February of 2009, nearly 150 million barrels in excess of that in storage today. The seasonal comparison chart that we look at each week, top pane is the last 12 to 14 months of commercial crude oil storage. The silver dash line is the 10-year average of commercial crude oil storage. We take the delta between the two and assess whether we have a surplus or a deficit, and plot that as the green bar graph in the lower pane. As you can see there, we have a 187 million barrel surplus, but we are slightly below the record we set last week. Cushing, Oklahoma is the physical delivery point for NYMEX light sweet crude oil futures. We added 500,000 barrels to storage there this week for a new record of 64.7 million barrels in storage. Total petroleum storage tracks the commercial crude oil storage plus 12 refined products monitored by EIA, and we have another new record here after just a very slight 300,000 barrel increase. Again, like we looked at the other charts, if we go back here to February time frame of 2009, still well below the all-time records we continue to set here. Exploration and production activity, represented here by the Baker Hughes rig count. This is U.S. land rigs focused on exploring for oil. We stacked out 31 rigs looking for oil last week, down to 467. I've added the brown dash line here, come back and see where that intersects, and we have to go all the way back to March of 2010 to find a similar low level of activity of rigs exploring for oil. Total rig count includes all rigs exploring for oil or natural gas, and this is for North America, so not just the United States, down to 543 rigs after stacking out 47 last week. The majority of those were rigs exploring for oil. Again, I've drawn that same brown dash line all the way back here, and it intersects all the way back in August of 1999. So every week as we stack out rigs, we'll set a new low for the 21st century. Over to pricing. The top pane is NYMEX light sweet crude oil futures. This is the continuous contract from Update Energy Feed, so this is roll adjusted. And then the bottom pane is the 10-year weighted average of seasonality. You can see each year here that beginning in the end of January, middle of February, where we are right now, we have a seasonal demand for crude oil that normally supports prices. However, in the short term, that is not the case this week. Over to a new chart that I just wanted to introduce. We won't cover this every week, but this is important, something I wanted to cover. The top pane, like we just discussed earlier, this is NYMEX light sweet NYMEX Light Sweet Crude Oil Futures. This is E-Signal's continuous contract in the top pane. And the bottom pane is the OVX. This is the Crude Oil Volatility Index. This is calculated by CBOE using a methodology very similar to what they do for the VIX that analyzes the S&P 500. I'd mentioned this in a written report previously. The high for this index had been 69 all the way back in the fall of 2011. This was about the time that we were dealing with the first Greece crisis. However, this year in 2016, we've been above 60. So crude oil, as everybody is well aware, been trading very volatile. It broke above that, and the index is now trading all the way up to 73.6. We have to go all the way back to the fall of or spring of 2009 to see similar elevated levels of volatility. The reason I bring that up is if you just kind of look intuitively at these two charts, that every time we've seen this elevated volatility, we've seen a short-term rise in crude oil or somewhat of a break from it. And then if you go back here to 2008, 2009, the OVX was as high as 100 intraday, and then shortly after that we set the low in February of 2009 and broke out later in March. So the thing that I want to caution everybody is like, okay, volatility is getting elevated. Are we putting a bottom in crude oil? Well, that's why it's important, I think, to go back and look at where we were fundamentally. So if we go and look at daily production back in 2009 at that time frame, again, about 5 1/3 million barrels per day. Now almost twice that. Commercial crude oil storage back in 2009, 350 million barrels today. Today we're 150 million barrels above that. Total petroleum storage, similar story. Back here in 2009, we set a record in 2014, and now we set a new record almost every week into 2015 and 16. So while we are seeing this increase in the oil volatility index that sometimes has been associated with a short-term bottom in crude oil, fundamentally it's very hard to paint a picture that we have set the bottom in crude oil, and certainly no indications of a new bull market in crude oil. And primarily the reason that I'm saying that is we have stacked out a lot of rigs. We're at a century-low rig count, but that has not translated into lower production. And until such time it does, it's very hard to make the case that we're going to work off these excesses in storage and see a serious bull market in oil again. We'll switch this back to the cloud chart. You can see here how easy it is to do that. This is the daily cloud chart. This is E-Signal's continuous contract, so not roll adjusted. Remember the things that we look at on these charts. Price is working below the cloud span. Lagging line is below the cloud span. The cloud span is negative, indicated by the reddish or pink colored background to it. And then we have the price below the turning line and the turning line below the standard line. So every possible parameter that we would look at on one of these cloud charts is still pointing to a bear market in crude oil. One thing I did want to show, if we go to Shift T on Update Analytics, this will draw a very nice 1% log chart, 3-box reversal, and put the automatic trends and targets in there. So similar to the cloud chart, very far below the bearish resistance line here, and then 2 downside targets, 24.15, and then one all the way down to $13.30. We'll kind of keep in mind that $24 target. Okay, over to the 60-minute point and figure chart. So this is down now 10-cent box size, 3-box reversal. We had this slight breakout with a new buy signal. It lasted not even a day. Reversed back down hard, took out the temporary bullish support line, and we just continue in this downtrend. I mentioned the $24 target earlier. I wanted to note here that the only downside target we have on this chart is down to about $23.50. So you've got 2 different time frames, 2 different box sizes that are showing a very similar target here, $23.50 to $24. Keep that in mind. That increases the probability that we will realize that target at some point, although we can't give a time frame for doing so. Over the actual futures, this is CLH 16. This is March NYMEX light sweet crude oil futures. This morning we were here right around $28, 27 3/4. A lot of volatility. One thing to note is Chairwoman Janet Yellen, the chairperson of the Federal Open Market Committee, was giving testimony this morning. Anytime she speaks, as you can expect, we've had a lot of volatility in the dollar index, precious metals, and of course, crude oil is correlated to the dollar. So let's discuss that now. In the top pane, NYMEX light sweet crude oil futures, E-signals continuous contract, and the center pane, the heavy green dash line, is the dollar index that trades on ICE. The heavy blue line is the all-time correlation between these two instruments, and as you would expect in an internationally fungible dollar-denominated commodity such as crude oil, that it would be an inverse relationship, and that's demonstrated with the minus 80. The bottom pane is the short-term correlation. This is just the last 65 days, and if we zoom in here a little bit, we can see that in the early part of 2016, that relationship was still negative, consistent with its long-term average. However, ever since just shortly after the new year, this has really changed. Now it's a positive correlation all the way up to a positive 40. And if we zoom in, we can really see here where as the dollar has descended here from almost 100 down to just below 97, that crude oil has had this sharp correction from $33 now down trading below 28. The forward curve for NYMEX light sweet crude oil futures, this data from the Update Energy feed. If we go back and look 5 days ago, just getting hammered at all delivery points, so the entire curve has shifted down. ULS diesel, we had a slight drawdown this week below the record that we set in the early part of January, in excess of 140 million barrels. The seasonal comparison chart for ULS diesel, very similar to what we do with crude oil. The only difference is instead of a 10-year average, we use a 5-year average for ULS diesel, and that's represented by the royal blue dash line. The delta between the two is plotted as a bar graph in the bottom pane, and you can see here we're working on nearly 33 million barrel surplus over and above the 5-year average of ULS diesel storage. Seasonality for ULS diesel, top pane is E-signals continuous contract, so this is not roll adjusted, but it mirrors the same seasonality we saw with crude oil, not surprising. End of January through the middle of February where we are now, we should be experiencing some seasonal strength, and it's a little bit better than crude oil, but not good. Over to the daily cloud chart, same E-signal continuous data. Almost the exact same situation as we had with crude oil. Price and lagging line below the cloud. Cloud spans are negative. The only difference here is the turning lines above the standard, but the price is descending below that, so those will probably cross again shortly. Again, very bearish picture and a very long way to go. A lot of work to do before this would be considered reversing into an uptrend. Over to the 60-minute point and figure chart for ULS diesel. This is the half cent per box size, 3-box reversal. Still well below this bearish resistance line that extends from last year. Still in the downtrend. One active downside target to 82 cents, and then today we realized this downside target to 98 cents. Over to the 15-minute close chart. This is HOH6, so this is March ULS diesel delivery. Similar to crude oil. We're right here about 98 cents at the report, and then some volatility shortly thereafter. The 1-to-1 crack spread is just a very gross approximation using a difference in the ULS diesel futures and light sweet crude oil futures. Give an example of gross profitability. This has moved up some. Crude oil has been descending much more than ULS diesel, so this spread has opened up slightly after getting down here and testing $8. The forward curve, we go back 5 days ago. Similar to crude oil, we're down at all deliveries. Gasoline had another build this week. We're up to another all-time record, so that is very bearish for gasoline. Over to the seasonal comparison chart, we do shift back to a 10-year average here for this light blue dashed line. The delta between the two, 25 million barrels. You can see that's a record over the last year for a surplus of gasoline storage. Gasoline seasonality mirrors what we saw with crude oil and ULS diesel. We're at a time now where we should be having a bid for a gasoline. Typically, this is going to be associated with building gasoline inventories for the summer driving season in America. But you can see when we're already at record gasoline storage, it's hard to imagine much demand for it. And if we do zoom in here, certainly this is still working in a downtrend. We have seen none of this seasonal strength in gasoline. The daily cloud chart bears that out as well. Price and lagging line well below the cloud. They have been ever since back in July of 2015. The cloud spans are negative. Huge gap between the turning and standard line and well below the turning line. So gasoline with that record all-time storage at a time when we would normally be trying to build that storage is just being decimated right now. Over to the 60-minute point and figure chart, below this bearish resistance line that we've been in pretty much all year. One thing to note here, we realized this 91-cent downside target today. There are no upside targets in gasoline, and you can see that there's 4 active downside targets. So just overall a very bearish picture for gasoline. Surprisingly, though, on the 15-minute close chart of the actual futures, this is XRBH6. March gasoline delivery. After the report this morning, we're down here about 93 cents. We're up to 95. Not sure why that's been bid up today. The 1-to-1 crack spread, we construct this similar to what we talked about in ULS diesel. So this is just a gross profitability measure between gasoline futures and crude oil futures. $12, but still well below some of the higher ranges we've seen. If we go back here to 2014, in February and March, we were up above 20 all the way up to 24. Similar story in 2015, well above 20, and we're struggling down at $12, but that shouldn't be surprising given the record storage of gasoline. Forward curve for gasoline futures. Again, this comes to you via the Update Energy feed. Go back 5 days ago, and we are down well below where we were at all deliveries. This is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, February 10th, 2016. If you have questions or comments, please feel free to email me directly. If you'd like to learn more about Update Analytics and the Update Energy feed, please reach out to their sales team. Thank you, and we'll see you tomorrow with the Natural Gas Report.